There's a certain kind of gambler who's so good at gambling that everyone forgets he's still gambling. Masayoshi Son is that man. He turned a $20 million bet on a tiny Chinese startup into one of the greatest investment wins in history. That startup was Alibaba. And that one trade essentially built the SoftBank empire we know today. But here's the thing about people who get famous for making one enormous correct bet: they never stop. They can't. The rush becomes the point. So now Son is 68 years old, running one of the most leveraged balance sheets in the investment world, and he's gone all in on OpenAI. Not a little. Not a hedge. All in. Tens of billions of dollars. Borrowed money. His company's future. His legacy. If he's right, history remembers him as the man who bankrolled the most important technology ever built. If he's wrong, and there are real reasons to think he might be, SoftBank itself could collapse. Let's talk about how we got here. SoftBank was founded in 1981. Despite the name, it's not a bank. SoftBank literally means software bank, as in, a place where you went to buy software on physical disks back when that was a thing. Son built it into a Japanese telecom giant. Think AT&T, but in Japan. Mobile phones, broadband, the whole thing. That's the boring but profitable core of the business that most people outside Japan have never heard of. The part the world knows is the venture side. SoftBank has become arguably the most aggressive tech investor on the planet. And the origin story of that reputation comes down to one meeting, one bet, one moment of either genius or insanity depending on how you look at it. In 2000, Son met with a young Jack Ma and wrote a $20 million check for a company called Alibaba that most people had never heard of. That stake eventually became worth tens of billions. It's one of the greatest venture bets ever made, but success like that does something to a person. It tells them their instincts are infallible. That they see things others can't. And that belief, more than anything else, explains everything that's happened since. In 2017, Son launched the Vision Fund, a $100 billion vehicle that made SoftBank's previous investments look cautious. A third of the money came from SoftBank itself. The rest came from outside investors, the biggest being Saudi Arabia's sovereign wealth fund. The Vision Fund moved fast, invested huge, and made headlines constantly. It was Son's attempt to reshape the global technology landscape through sheer financial force. Then came WeWork. SoftBank poured $14 billion into a company that rented office space and called itself a tech startup. When WeWork tried to go public in 2019, investors actually read the prospectus and immediately questioned everything. The IPO collapsed. The valuation imploded. WeWork eventually declared bankruptcy in 2023. $14 billion. Gone. After that disaster, Son tried to raise Vision Fund too. Outside investors weren't interested. So Vision Fund 2 ended up being funded almost entirely by SoftBank's own money. Which matters a lot when we get to what happens next. Between 2024 and 2025, SoftBank invested $34.6 billion into OpenAI, acquiring roughly a 10% stake. To fund this, they sold other assets. Nvidia shares. Their entire T-Mobile position. They liquidated things that were working to double down on the biggest bet of Son's career. Then in March 2026, OpenAI announced a $122 billion funding round at an $852 billion valuation. SoftBank contributed $30 billion more, bringing their stake to approximately 13%, worth around $110 billion on paper. Here's the catch. SoftBank didn't have $30 billion in cash sitting around. The $30 billion was split into 3 tranches across 2026. And to bridge the gap, they took out a $40 billion bridge loan, a short-term instrument that needs to be refinanced by March 2027. A bridge loan is exactly what it sounds like. You use it to get from one side to the other quickly. The problem is you still have to build the bridge. Here's where it gets uncomfortable. SoftBank tried to get a $10 billion margin loan using their OpenAI shares as collateral. Banks said no. They reduced the ask to $6 billion. Banks still said no. As of July 2026, they're back at $10 billion, but this time the loan would have full recourse to SoftBank itself, meaning if OpenAI implodes, it's SoftBank's problem, not just the lenders. Why won't banks lend against OpenAI shares? Because OpenAI isn't publicly traded. Its valuation of $852 billion is largely built on circular financing arrangements and AI hype. Banks can't easily liquidate private shares. They can't accurately price them. So from their perspective, the collateral might as well not exist. This creates a genuinely strange situation. SoftBank owns a $110 billion stake in OpenAI on paper. But they can't borrow against it. Which means for practical financial purposes, it's worthless as leverage. SoftBank's other major asset is ARM, the semiconductor architecture company they acquired in 2016 for $31 billion. ARM went public in 2023 at a $54 billion valuation. Today it's valued at nearly $300 billion. On paper, SoftBank's 88% stake in ARM is worth $250 billion. That sounds incredible. But there's a problem. SoftBank owns 88% of ARM. That means only 12% of shares are actually trading in the public market. When almost nothing is available to trade, even small amounts of buying pressure send the price to absurd levels. The $300 billion valuation gets extrapolated from a tiny sliver of equity that doesn't represent what the whole company is actually worth. ARM generated $5 billion in revenue last year, growing 23%. Good numbers. But the stock trades at 58 times revenue and over 300 times earnings. The moment SoftBank starts selling, and they'll eventually need to, the float expands, price discovery happens, and that $250 billion on paper starts looking very different in reality. Here's the scenario nobody at SoftBank wants to say out loud. OpenAI delays its IPO, which already looks likely after the SpaceX debacle, where the most hyped IPO in recent memory cratered from $200 to $120 in weeks. Investment banks told Sam Altman directly that the SpaceX implosion is the reason OpenAI can't achieve a $1 trillion valuation this year. So OpenAI waits. Keeps burning cash. Eventually either runs out of money or goes public at a valuation that humiliates everyone involved. Meanwhile, SoftBank holds a $40 billion bridge loan coming due. Banks won't lend against OpenAI shares. They start selling ARM to cover debt. ARM's price collapses under selling pressure. Their leverage ratio, already at 33%, right at the edge of their own self-imposed limit, spikes. ARM is a real company with real profits. It won't go to zero. But an 80% decline from current levels would still leave it at 10x revenue, still not cheap. If that happens alongside OpenAI going to zero, SoftBank's asset base crumbles and the debt becomes a crisis. Is this likely? Probably not. But it's possible. And that's exactly what SoftBank's own executives are quietly saying to each other. Masayoshi Son stood up at SoftBank's annual shareholder meeting in June 2026 and told investors he's no longer motivated by money. He wants to build his legacy. He wants to be the man who financed artificial superintelligence. He's 68. He originally planned to retire. Now he wants another decade. This is the psychology of someone who has spent their entire life making enormous bets and winning more than they've lost. The Alibaba trade is burned into his identity. He thinks he can see the future. And when you think you can see the future, the size of the bet feels like confidence rather than recklessness. The same instincts that made him a billionaire might be the ones that end his company. That's the thing about gamblers. They're not wrong often. But when they are, they're catastrophically wrong. And right now, SoftBank is holding the biggest hand Masayoshi Son has ever played.